Bob Hoopsher, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. Churchill Asset Management invests in middle market companies. It is part of Nuveen, and it raises capital from investors through commingled funds, separately managed accounts, business development companies, and collateralized loan obligations. In February, Nuveen and Churchill announced the launch of PCAP, a business development company that offers individual investors access to private capital investments across the U.S. middle market. And my guest today, Alona Gornick, works with advisors who invest in this space. She will discuss the market environment and how advisors are approaching it, the risk-return profile for this type of investment, and the questions advisors should ask as they approach this opportunity. So, Alona, tell me about your career path, what led you to Churchill and your role there.
Sure, Bob, and thanks so much for having me on the show. For my career, there's never been a dull moment on this journey. Over the past 20 years or so, I'd say it's been a great mix of luck, timing, hard work, and a few incredible mentors for sure. Before Churchill, there have been really three stops for me. First stop in investment banking. That's where I kind of got the intro in how to structure deals and sell them to the institutional market. And then second stop, high yield bond investing, really learning how to sort of outperform the benchmarks, doing a lot of comparable company analysis. And then the third stop, high grade private debt investing, and really taught me how to kind of dig deep, look at fundamental credit analysis, think about being a buy and hold investor, really the dynamics of price discovery. So I'd say each stop along the way helped me develop a pretty keen new professional instinct that I'd say in looking back, the combination of all of that turned out to be the right mix for my role at Churchill, which is as a middle market direct lender in origination. So that's what I've been doing for the past 7 years. And that involves deal structure. It involves investment analysis. It involves relationship development. So all that combined has been fantastic for me at Churchill. And now I'm sitting in the seat as an investment strategist where I get to bring insights on what we're seeing in private capital, particularly private credit, to the wealth community.
Well, we are very interested in hearing about what you are seeing in private capital. So, talk about Churchill Asset Management. How are you making private capital more accessible now to the private wealth community?
Sure. So at Churchill, we've been a private capital solutions provider for the past 17 years. And really, our roots are in direct lending. We're now one of the largest and most active platforms focused on the US middle market. We've got 4 core investment strategies today. There's senior secured lending, junior capital investing, private equity co-investing, and then private equity fund investing. We are majority owned by Nuveen, as you mentioned at the outset, and we really operate as Nuveen's sort of dedicated US private capital manager. We've got over 150 people, and together we manage about $46 billion of committed capital. And that's on behalf of over 1,700 investors. We've created over 40 different investment vehicles and products, really to meet the needs of our investors, and including 2 registered business development companies, which we launched in the last 3 years. And through these business development companies, or BDCs, we've been able to offer meaningfully lower minimum investment requirements, simplified tax reporting, and really robust portfolio reporting, which is far more accessible to the wealth channel, as you mentioned.
And the entity that I mentioned in my introduction, PCAP, PCAP, is a business development company that you introduced earlier this year. So it seems that private capital, particularly private credit, has become very popular among advisors and their clients. What are the reasons driving that focus?
Sure, there's quite a few reasons, but simply put, I'd say private credit in particular is one, it's compelling. 2, it's unique. And 3, it is accessible, just at the top. So compelling, what do I mean by that? Compelling to me is something where you actually are seeing natural benefits for private credit, really addressing a lot of investors' concerns today in this environment where you've got a lot of uncertainty, a lot of concern around rates and inflation, recession, mild or deep, continued volatility in the public markets, and then just continuous geopolitical tension. All of that is on top of investors' minds today. And private credit naturally has benefits that address a variety of these concerns. You've got current income, now yielding in the double-digit area. You've got inflation protection, where this asset class really has floating rate structures. And then you've got far less correlation to public markets and traditional asset classes. So really naturally compelling in that way. I guess second, I also mentioned uniqueness of the asset class. We're really in an environment unlike one we've ever seen, right? You've got a multitude of pressures all happening at once, really, come on after the pandemic, and then the Fed's actions to combat inflation. Got, of course, the mix of what's happening overseas and really that impact on commodities and other markets. And then you've got a whole multitude of new investment opportunities. So really, investors got a lot at its plate to really assess and figure out what to do. So private credit is really uniquely positioned to outperform in this environment. It's shown a lot of resilience. You've got top of the capital structure investment instruments with extremely low loss rates. And that's been demonstrated over decades plus. So really a lot of alignment, really interesting alignment between a borrower or the owner of a business and the lender. And those aspects are really coming into light right now. And finally, the most important piece I think folks are really focused on private credit is accessibility. Private credit is now much more widely accessible to the wealth community than it ever has been before, driven by a variety of innovative new products. We talked earlier about these business development corporations or BDCs, and PCAP or PCAP, as you'd mentioned earlier, is one of those. Initially, private credit has grown quite a bit, driven largely by institutional investment, right? Those investors that could meet the really high minimums and be comfortable with longer lockup periods. But now managers who are really trying to be opportunistic have tried to create fund structures that can reach a wider audience, right? A wider investor audience. And that includes feeder funds, registered funds, interval funds, and these BDCs, business development companies, that can come in multiple flavors. Got perpetually private, public BDCs, non-traded BDCs, private to public BDCs. All of these BDCs have lower minimums, more flexible liquidity features, and as I mentioned earlier, really simplified tax reporting that really speaks to a broader audience right now. These BDCs are intended to be yield oriented, so great in a time where we're seeing a lot of volatility in the market, a lot of concern about realizations. So that yield orientation is very attractive. And BDCs are typically required to distribute at least 90% of their profits. So they're very well suited for private credit because private credit investment strategies actually generate interest income from a diversified portfolio of high quality loans. So really well suited for the BDC vehicle. And now BDC formation has really exploded over the past 2 years. And we've got probably over 20 different sponsors in the registration process right now, trying to bring more to the market. So I believe there's about 140 plus BDCs in the US today. A mix, as I said, publicly traded and non-publicly traded, with over 60 billion or so of market cap. So really a healthy place to see more private credit continue to grow. And as an asset class, altogether, private credit's approaching over $1.5 trillion. So really, it's become quite established, with industry veterans kind of pointing to a doubling of size in the next 5 years and maybe even tripling over the next 10. So we think this industry is going to continue to evolve to meet that growing appetite of the very largely untapped wealth channel.
What are the investment minimums among BDCs? And maybe you can talk a little bit about what the expenses or fees are for them, at least at a generic level, maybe not specifically for the Churchill products.
Sure. So minimums, as I said, are much lower and more accessible to individual investors. They can range from as low as $2,500 as a minimum, coming in typically on a monthly basis for monthly subscription, to $50,000, depending on the type of BDC it is or the type of fund it is. And then in terms of fees, there's typically a management fee and a performance fee. And those management fees can range in the area of, call it 1% or 1.25%. Some are as low as 75 basis points or 0.75%. And then on the performance fee side, you can see those range from about, call it 12 or 15%, after a fund reaches a hurdle. That hurdle can be anywhere of 5 or 6% of a return.
Churchill invests in middle market companies. What is the middle market and why do you focus your efforts there?
So we see the middle market as really the lifeblood of private capital, and specifically private credit. The size alone presents an enormous opportunity. There are over 200,000 private businesses considered middle market in size. And that would be a business that's got anywhere between, call it 10 million of revenue to up to a billion of revenue. It's extremely diverse by industry segment and really represents the real economy of the United States, right? It employs over a third of the economy's workforce. So combined, if you brought all the revenue together across the middle market, it would actually make up the third largest economy in the world. We've got a lot of established businesses here, and they just happen to be too small to access the public credit markets. So why does Churchill focus on it? We see a number of attractive attributes here, and particularly one, we see significant market opportunity for investment. I mentioned the 200,000 businesses considered middle market in size. What astounds me is that less than 5% of those today have private equity backing, which means significant white space for continued acquisition by both by private equity firms and strategic buyers that will require private debt capital. So we see it as certainly a lot of opportunity for private credit. We also see it as a really unique sweet spot where you've got attractive entry points compared to large corporate buyouts, so lower purchase price multiples. And what we've seen is historically higher growth rates in the middle market. Second, I'd say the middle market also has typically more conservative capital structures. So that to us would really drive more of an enhanced risk adjusted return throughout cycles. Third, I'd say the middle market also has really a number of ways to create value. You could see investment strategies here that run from, growth through M&A. You see opportunities to professionalize operations, opportunities to top grade talent, replace talent, put in C-level professionals that weren't there before, build out regional density where there had been sort of a great market presence in one market, but kind of building out that route density there, and maybe even entering into new markets. So multiple value creation levers for the middle market. And then fourth and most interesting, there are many ways to exit, right? The middle market isn't reliant on public markets to actually realize your investment. So you're often seeing middle market businesses being sold to other private equity sponsors, so it stays private. You can see middle market businesses being sold to other sponsors through platforms that they own today where they're trying to make an acquisition, so a sponsor-backed strategic play, or even corporate strategic buyers. And I think having multiple exit options is really, really helpful when you're thinking about, value preservation plus realization in any cycle.
So it's a fertile area. It has very attractive risk return characteristics, and there are multiple exit strategies. How do they typically fit into the portfolios of the clients who are served by financial advisors, the high or ultra high net worth investors that advisors are working with?
Sure. So we're seeing investors really turning to private capital and particularly private credit for a number of reasons, notably that steady current income generation, number one. Um, Really, when you're pursuing an investment strategy that in the high net worth space can somewhat be a bit barbelled into, okay, I'm going to do a lot in the publics, and then I'm going to do a lot in alternatives. You will see a need to actually hold cash back or have a good bit of cash to actually commit to those alternative strategies. Well, private credit actually creates current income for you because of that interest earning instrument. So that's been an incredibly attractive benefit. Two, I'd say that risk adjusted return, you're seeing a yield premium because of that illiquidity, but you're seeing it come with much lower loss rates and much higher recovery rates than public fixed income. So, really, an attractive risk adjusted return prospect. And then, third, inflation protection. The predominant feature for senior secured loans is a floating rate structure. So in this environment where we've seen rates skyrocket, 10 hikes, over the last year plus, has certainly benefited anyone invested in senior loans in the form of much higher, almost double-digit yields now on senior secured loans. And fourth, I'd say diversification. Really, in a portfolio, you're going to benefit from less correlation with private credit and have that downside risk protection. And finally, lower mark to market volatility because senior secured loans, private credit are really valued on a fundamental basis and not based on what the market thinks it would be worth. So less market psychology involved. Overall, we're seeing more advisors carve out dedicated allocations to alternatives. They're conducting a lot more research on the variety of alternative investment strategies in the private, less liquid universe of asset classes. And, we've seen allocations to alternatives range from, call it 10 to 20% to as high as 40%. But within that, private equity and private debt still have a ways to go. So I certainly think there's room to run.
Let's pause for a couple of minutes for a word from our sponsor. I know that you already enjoy our content from Advisor Perspectives every day, so why not use our award-winning articles, commentaries, and charts to streamline your communications with clients and prospects? My team and I introduced AP Premium last summer, and we've been blown away by the response from the advisor community. Keep listening for an exclusive code to get $10 off our premium service. You won't find the in-depth, sophisticated market analysis and charts like Advisor Perspectives anywhere else. This information can be invaluable to help your clients understand complex topics. Let's say a client asks a question about their estate plan. Instead of spending time researching and drafting a long-winded response, quickly grab any number of related articles from our library and share it in a personalized way. AP Premium gives you the power to add your logo and a personalized message to any piece of content and share it directly with your clients and prospects. We also introduced a premium offering called the Ask an Expert webinar series. At our inaugural session, we were joined by Wade Pfau for an intimate Q&A. Advisors have told me this is one of their favorite perks of being a premium member, and we can't wait to share who's slated to join us next. Give Premium a try and see for yourself why it pays to be a premium member. As always, we appreciate your support of our efforts to bring excellence to financial journalism. And as a thank you, I'm offering a one-time $10 discount for new premium members to be taken off your first monthly or annual payment. Just go to advisorperspectives.com/member. That's advisorperspectives.com/member and use the code podcast 2022. That's podcast 2022, all caps, at checkout. And now back to our podcast. You've spoken about the macro environment. We're still facing some higher than historical inflation, although that seems to be coming down. Rates have paused for the time being. We've got some geopolitical risks. Given the uncertainties in the macro environment, is now the right time for retail investors to invest in private capital?
It's certainly quite a challenging and interesting time. I'd say for private capital, it's incredible. Um, Namely, I'd say the yield environment we're in is is one that we haven't seen probably since 2010. We're seeing yields in the low double digit context for first lien, senior secured, top of the capital structure, middle market loans. So all in asset level yields are up 400 to 500 basis points. They're approaching 12% on what used to be 6 to 7% just a year plus ago. Now, as you mentioned, while the Fed recently decided to pause on another rate hike in June, we still believe rates will remain higher for longer. So we think this yield environment will be available to private credit for the foreseeable future here. Second, I think this is quite a compelling vintage. Industry veterans are referring to private credit as having its golden moment. You've got higher rates, you've got higher yields, but you've also got better terms and you've got better companies. With the market uncertainty and capital scarcity, we finally have negotiating power in the hands of capital providers, right? After a decade plus of being a borrower's market, it's finally a lender's market. So what you're seeing is a flight to quality. Borrowers that are able to prove operating resilience, that can pass through price increases, that can do more with less, including under the constraints of higher interest costs, those are the types of companies that can obtain financing in this market. And in new deals, what we're doing today is seeing much lower loan to value ratios in the range of, call it 40%, 30 to 40%. We're seeing much higher equity contribution, in the range of, call it 50, 60, sometimes 70%, because of much more resilient purchase price multiples that we see in the middle market. That comes out to pretty conservative balance sheets and much better lender protections that, all in all, would likely prove out to be one of the best vintages for private credit, which you typically see coming out of years where you're in or directly after some periods of dislocation or turbulence. So really compelling vintage. And finally, if you think about, is the right time now? I'd say if you're not convinced after those first two, going forward, we really do see significant and sustainable demand for the asset class. It's really attractive to both investors and borrowers. You've got private equity sponsors who are typically the owners of the middle market businesses borrowing utilizing private credit today. They continue to migrate from the broadly syndicated public credit markets into the direct lending market. Now, why is that? Largely because private equity firms are now really wanting to see that highly customized, more efficient, more stable financing that's coming out of the direct lending market that they can now get out of much more scaled lending platforms with meaningful dry powder. For example, in the first quarter this year, leveraged buyout activity that was executed in the direct lending market was 5 times greater than the volume executed in the syndicated market. So really a taking of share from the public markets is certainly one that we've seen as a trend. And then second, going forward, I'd say there is meaningful demand for private credit outpacing what we see as supply. So if you look at private equity dry powder, there's over $560 billion sitting on the side of raised private equity dollars. Now that compares to only, call it 145 billion of private debt, middle market private debt dollars already raised. That gap of over $400 billion is really important to take a look at, because to us, it represents in the ground, yet to be raised demand for private credit of at least another $400 billion to be deployed over the next 3 to 5 years. And that assumes that private equity firms have the incentive to deploy their dry powder in leveraged buyouts that will utilize private debt in maybe at least a 50-50 debt to equity structure. So matching their dollars for private debt dollars. So certainly in the ground demand for private credit going forward. And finally, that the turbulence that we saw in the traditional banking space in March that has continued and continues to tighten lending standards, that certainly represents a meaningful opportunity for non-bank lenders to step in where traditional banks are going to be retrenching and stepping out.
Let's look at this from the perspective of a manager like Churchill. You just described how there's relatively less capital to be deployed than there is, say, in private equity. What is it that differentiates Churchill from its peers, and what are the characteristics that Churchill has that will make it a successful investor in this middle market space?
Advisors are evaluating private capital managers. There's a whole host of attributes they run through, right? And I'd imagine at the top of everyone's list is certainly rigorous underwriting, portfolio management, strong track records. I'd say those three are absolutely table stakes, right? Every manager should be showing great track record, rigorous underwriting, and strong portfolio management processes. So that's a must. But in a very benign environment, I'd say most managers can demonstrate that. Solid track records, minimal losses. It's been really hard to differentiate in those areas. So the real question may be, well, how do you see managers actually differentiating and creating value for investors outside of those key attributes? One area that we've seen actually show some differentiation is in sourcing, right? Does a manager have unique access to deal flow? And how would that show itself? It would be demonstrated in the depths of their relationships, right? And also their ability for a manager to steadily deploy capital, even in a slower M&A environment like we're seeing today. Is your capital deployment steady or is it sporadic? Can you leverage the depth of your relationships to see deal flow in a slower market? These are the questions that advisors should be asking managers to really understand, is your sourcing strategy truly differentiated? And at Churchill, we certainly emphasize one of our areas of key differentiation, which is an entrenched relationship model that is rooted in our investment in funds. We've got over nearly $13 billion of a portfolio of fund investments in top performing middle market funds. And that gives us not only the front row seat into deal flow, but also the first call on deals when there are financing opportunities to be had. So our status as a highly valuable limited partner in over 270 funds certainly gives us that edge. And for us, that means sourcing not only quality, but quantity. We want to source as much as possible at the top of the funnel so that we can be selective. And then once you're selective, you also want to be able to turn down without the negative repercussion of not seeing the next deal. And as a limited partner fund, we definitely get the benefit of the doubt. And certainly on the 9th turn down, we get the 10th and the 11th deal shown to us and can continue on with a great relationship with that private equity firm to see deal flow going forward. So really that ability to see and source quality and quantity at the same time allows Churchill to build what we call an all-weather portfolio of the best quality deals that can perform through any cycle.
Wonderful. What are some of the efforts that you're doing to educate advisors about this space, and how important is education?
We see education as extremely important. In the world of wealth, it seems that you need to clearly and continuously communicate advisors and educate advisors on what's happening in the market, how the market's changing, and where the real opportunities are. For advisors, we think it's important that they educate their individual investors to really understand how the largely illiquid nature of private market investments can impact their portfolios and how they can identify structures that can provide adequate liquidity to meet their investors' needs. So we approach fundraising in this channel in a very different way. It's all about brand awareness. It's about validity. It's about trustworthiness. All of those elements really matter. And advisors really want to understand the full picture. What are the opportunities and what are the risks in the current environment? They really have to be, a trusted, expert in the space, even though they are not investing in it directly. So trust in the wealth channel certainly takes time and effort. And managers who can actually take the time to meet with advisors and address the questions they have with market color, because they're active in the space right now, can provide that context and really improve the confidence in the asset class.
Well, speaking of meeting with advisors, I know you've been on the road. You've been meeting with some RIAs, with BD reps and wirehouse reps. Are there some common questions that you've been hearing from them?
Certainly, thematically, a lot has turned to sort of, number one, defaults and portfolio health. I think that's been top of mind for advisors. How will borrowers continue to pay elevated interest costs and still run their businesses? How are they going to pursue growth plans? Are managers equipped to handle distress and defaults in their portfolios? Do they have workout expertise? I think all these questions around the topic of defaults and portfolio health is certainly one key topic that comes up. I'd say second, there's certainly a curiosity about the current deal environment. What do the spreads and structures and terms look like today? How do you underwrite new loans and assess the risks in such an uncertain environment? And I'd say the third recurring topic or theme that comes up is really what is our outlook and of the asset class and the impact of recession and rates and inflation on this asset class going forward. How is private credit really going to perform in the long run? So those are sort of the three key topics that we continue to run into today.
You spoke earlier about the need to evaluate the track record and the process and the team as sort of table stakes, and then the need to evaluate the way in which a manager sources deals. If there's one key takeaway that you'd like to leave with our audience of advisors about the diligence that they should perform on a private market investment, what would that be?
To evaluate managers not only on their best investments, but on their most challenging investments and what they learned from them and how did they implement those lessons going forward. I think manager selection is absolutely critical in today's environment, for sure. And private market investing is all about relationships. That's the key to deal sourcing. The depth of a relationship is more than who you know. It's who trusts you to partner on a deal in good times and bad. So even when deals go south, how did a manager perform? How did it work with its other lending partners? And how did it work with the borrower, the private equity owner of that business? Once you dive into private capital, you're going to see a very wide variety of investment strategies, both within private equity and private credit. And what you'll find is there are abundant opportunities. The demand is incredible. I'll tell you, Bob, we rarely encounter direct head-to-head competition among private credit managers. We turn down about 95% of the deals we see. So somebody else is doing them, right? There are so many investment strategies within private credit and across the middle market. So my final advice to advisors really exploring this space is learn as much as you can. Meet a variety of managers, and truly try to understand their key differentiators. And if you're thinking about building a sound private credit allocation, consider stacking complementary strategies from a few managers. It's really an excellent approach to sort of getting that exposure to private credit for a portfolio.
Well, we will include a link to the Churchill Asset Management website in the notes that accompany this podcast. Alona, is there anything else you'd like to add?
Just want to thank you, Bob, for the opportunity to talk with everyone today. Certainly feel free to reach out and reach that website if you have any interest to learn more about Churchill or the private capital space. Thank you so much.
Well, you're welcome. And thank you for listening to the Gaining Perspective podcast with Bob Hoopsher, today featuring Alona Gornick of Churchill Asset Management. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on iTunes, Spotify, and Stitcher.